like to thank everybody for joining us today. I am Jarrett Seaberg, a Managing Director and Senior Policy Analyst at Guggenheim, specializing in financial regulation. And that is our topic today. As your moderator for our event, I promise that we will move quickly through these topics. There'll be short introductions. We won't have any long speeches, and we'll try to keep this lively and as interactive as possible. We have an excellent panel. With us today is James Barth with the Milken Institute, Senator Bob Corker, a Republican from Tennessee and a member of the Banking Committee, Gary Lathrop, a Managing Director at Citi and the head of Global Credit Markets, Kevin Lynch, the Vice Chairman at BMO Financial Group, and Tom Pirelli, a partner at Jenner & Block, and perhaps best known as the former Associate U.S. Attorney General. We are going to keep things moving, and because we only have an hour and we have numerous topics that we're going to try to get through, including is big bad in the financial space? Should we worry about too big to fail? Do governments need to break up the mega banks? Will the Basel III capital rules actually work? How do we deal with sovereign debt troubles? What are the ramifications of a financial transaction tax? How do you regulate non-bank financial players? And how do you implement regulatory regimes across the globe? We're going to kick our debate off with the too big to fail issue. And if they could put slide 1 up, please. See if this actually works. All right. As you can see from the slide, the banks are clearly getting bigger. And if we go to slide 7, you'll see that well, that slide 7 is not the same as the slide 7 in the notes. So we will skip that slide 7 and hopefully go to slide 4, which will be more indicative of what we had. So while the banks are getting bigger, if you look at the United States, relatively speaking, the 4 biggest banks are actually quite small as a percent of GDP compared to the rest of the world. So with that backdrop, where banks are getting large, but perhaps not really that big by global standards, the real question is, should they be broken up? This is a big issue on Capitol Hill today, and it seems only appropriate. We'll start with our representative of the U.S. Congress, Senator Corker, and let's just begin with a simple question. Do we need to break up the big banks?
Well, I think we have 3 of the top 15 banks in the world. We have 3 of those, and I don't think people realize that when they begin talking about the size of our institutions. So I think the thing we need to look at is, are these institutions unfairly receiving some kind of subsidy because they're viewed to be too big to fail? That's the issue that I think we need to look at before we move along with anything else. We had, as a part of our budget resolution, Jared, a 99-zip vote to actually get the GAO to look at that. Are there things about these institutions where they are receiving unfairly some kind of U.S. perceived subsidy because people think that they are too big to fail? So to me, that's the basis from which we start. I was just in Japan, and one of the things that was said there is interesting, and I think that's what's driving some of the public sentiment. We had this crisis, and really nothing happened. I mean, executives in many cases were still employed. Shareholders obviously took a hit. Many creditors did not. But they talked about the Asian crisis and the fact there was a situation where people in some cases committed hara-kiri. I mean, they actually were so embarrassed about what had happened. So there is a little public sentiment about the fact that we never really dealt with this issue properly. But I think the best way for us to deal with it is to go through it methodically, understand why these institutions are large, the social mission that they have around the world, and not jump to artificial elements that Congress may put in place that have no bearing.
Well, James, what do you think about that? Let's skip the hara-kiri for a second, but I mean, are the banks too big?
I think the senator is actually correct. We should eliminate any subsidies associated with big banks. We shouldn't have a too big to fail policy in place here in the United States or any other country, in my view. But I don't think that big banks caused the financial crisis that we just came through. I think it's wrong to think if we break up big banks into, say, 1,000 banks, we won't have any more banking problems. I think that's wishful thinking. I don't think will work. So I'm totally opposed to simply thinking that if we break up the big banks, we're never going to have any banking problems again here in the United States. I do think big banks have received a subsidy. The Dodd-Frank Act is supposed to basically eliminate the too big to fail problem. But I don't think the solution is simply to break up the big banks today. How do you break them up? As you showed in the slide, there are different ways of talking about size of banks. You can talk about the share of total assets by the big banks. You can talk about total assets of big banks relative to GDP. The U.S. has relatively small banks in many respects compared to other big banks in other countries around the world. So I think there's a lot of downside risk to breaking up big banks that I don't think will solve our problems.
Well, but Tom, the U.S. Attorney General has suggested that the big banks are too big to prosecute. Does that alone perhaps suggest that maybe they need to get smaller?
I guess my starting point is that big is not necessarily bad, and as some of the panelists heard me talk about before, some of that experience comes out of dealing with a completely different regulatory nightmare, which was Deepwater Horizon. I think a lot of people would look at that and say, if that had been a small company that had had that explosion in the Gulf, there wouldn't have been somebody there to compensate victims, there wouldn't have been anybody there to clean up the mess. So the notion that big is the problem is not one I necessarily buy. I will say that sitting in the seat of a government official and looking out at the regulatory environment of financial institutions, to me the big challenge was opacity, actually trying to understand what it is that institutions hold and all the interconnections in the economy. That is, to me, the biggest challenge in trying to come up with a responsible enforcement posture.
Okay, well, maybe we can get Carrie from Citigroup to argue to break up the big banks. What do you think?
I thought it was interesting that I'm sitting in the middle. I figured I'd be getting it from both sides here. But I'm not in the camp that I think size is the problem. I think size allows us scale to be able to service our clients, particularly some of our large multinational companies and champions based in this country, and being able to service them throughout the world. There is a level of size and scale that's required. And rather than trying to decide that the right size for an institution is 500 billion or 200 billion, and I'll give you an answer, but my thought is you can break up a $2 billion bank and make it 10, or $2 trillion bank and make it 10 $200 billion banks. The reality is, they'll be probably doing the same things, because depending on what the capital requirements are, if you have zero risk weighting on government securities or very onerous risk weightings on other types of securities or loans, that's what the composition of the balance sheet will look like, and most of the banks will look very, very similar. So as much as, or as distasteful as too big to fail is, I think, and maybe a year from now, maybe 10 years from now, maybe 100 years from now, we'll find ourselves in a situation. It's not just related to a bank. We face this in the crisis with the auto companies. Is, do you let this go down, and what's the implication, the cost of just letting it go, or what's the cost for society of trying to ease it down? And that's where I think the attention should be focused. I think some of the what we saw happen with Cyprus and the discussions about bail-ins, internalizing the cost of failure. So there is a problem, and like I said, I'm confident at some point in the future, something that none of us see coming will create another problem. Can you allow the institution to fail without kind of a daisy chain of pulling down other institutions, or ultimately, the economy? And that's where I think most of the attention should be focused today.
Well, speaking of that, Kevin, we haven't let you weigh in yet, and I wanted to ask you to maybe focus a little bit on, you have to compete against J.P. Morgan, for business in the United States. Are you at a disadvantage? Are, regional banks, no matter how big their size, how big their parent companies, at a disadvantage in competing against the mega banks?
Well, that's a good question. Let me just step back, though, because I'm kind of the Canadian on kind of a panel, and the issues are similar, but there are kind of differences across. And if you think about it, the United States has gone through its worst financial crisis since 1929-30, its worst recession since kind of the 1930s, and the slowest recovery. And that's been really difficult in the United States. It's been difficult in the UK. But it's interesting to note that not every country has gone through it. Canada didn't have a financial crisis, Australia didn't, Sweden didn't, and a number of emerging markets. And in Canada, we have large banks. We have 5 large banks. So I don't think bigness is necessarily badness. I think when you've got poor quality assets, kind of huge leverage, and complexity that your risk management kind of systems can't handle it, that's bad banking, not kind of big banks. And I think that's what we should focus on, is kind of why it happened and to make sure that those factors aren't there in the future.
But do you see a competitive disadvantage when you try to go up in the United States against one of the mega banks?
No, I think the Canadian banks would say as long as it's a level playing field, then those that have the best products and kind of good costs should do well. So for us, it's the level playing field and kind of access, and that's a risk that I think increasingly we should come back to, because I think we are starting to see across the financial systems fragmentation as people kind of work in different ways at the issue in front of us.
James, I can tell you're dying to get in here. Go ahead.
Well, I don't know of a single piece of evidence suggesting that size per se has caused a financial crisis in any country around the world. There's no evidence that I know of that suggests that size per se is the problem. I think what Kevin said is exactly correct, which is excessive risk, excessive leverage, and bad regulation, basically, of banks, or inability of the regulatory authorities to deal with the banking problems. I think that's the problem. So I think we'd be basically moving down the wrong path if we simply believe that if we break up the big banks, there'd never be a banking problem.
Well, some would argue that maybe Congress is partly responsible for repealing the Glass-Steagall Act, which was before Senator Corker was a senator. But Glass-Steagall disappeared. We allowed more mixing of commercial and investment banking. Some propose that the solution is to bring Glass-Steagall back. Senator Corker, do you think there's support in Congress to do that? Does that make sense?
I don't think there is. There was prop trading, and derivatives were still a big part of the system when you had Glass-Steagall. So, Volcker was a step, to move prop trading out of financial holding companies, and that's going to happen. I think at the end of the day, the regulators will still allow market making. It is hard to get inside of a trader's head and understand whether it's prop trading or market making, and I think that's going to be a difficult fine line to achieve, but I really don't think that's where we're headed, and I think people realize that those types of issues really had nothing to do with the crisis that just came. I mean, one of the problems with Congress is a crisis occurs and we try to solve it. We have a solution that really doesn't apply to what just happened. I couldn't agree more that, at the end of the day, what happened during this last crisis, a lot of bad loans were made. I mean, it's kind of the essence of what banking is. And, the multiplier effects that exist in our system with bad loans is what created the problem. So, yes, it was bad banking. And we need to have a much better regulatory regime, but it wasn't some of the things where solutions, we have solutions that are looking for a problem in many cases, and I think we need to be very careful of that.
Kerry, Citigroup sort of led the way for Glass-Steagall to be repealed. I recall much of that. What advantages does Citigroup have from being able to mix these businesses together? Is there real value there?
Again, before I answer that, I mean, when you look at some of the institutions that failed, ironically, you wouldn't talk about some of it being the global banks. If you look at Lehman and Bear Stearns, monoline investment banks. If you look at Washington Mutual, or in the UK, Northern Rock, more traditional commercial banks. So there are advantages again for us in that, and I think there's a lack of understanding. I think people assume that everything happens like at the Citibank level, and you have really, Citigroup is a broker-dealer and a bank, and certain activities are run in the broker-dealer, and we fund ourselves like a broker-dealer, like what was historically an investment bank, and there's certain activities, particularly lending activities, that happen on the bank, and it's very regulated as to what can happen on the different entities. But there are advantages of having the different entities and being able to service our clients, depending on what their needs are, to be able to have the bank and the broker-dealer. But again, there's very distinct and separate operations that occur on those two entities, and I think And again, that's in the US, and you go internationally, there is a lot more of like the funding of trading operations that occur at the bank level. And some of the discussions now are about separating it and making some of those institutions, particularly in the UK, look probably more like what the US banks look like today.
Well, that's a great transition because I did want to get to the Vickers plan, which proposes just to do that. Do I have a volunteer to tackle whether that makes any sense? Or do I have to put one of your feet over the fire? James, I know this is...
The Volcker, the Vickers, League can plan to sort of ring fence certain types of activities. I think one should look at what actually caused the financial crisis. I think if one does that, one's not going to find it had anything to do with proprietary trading. Proprietary trading did impose some losses on institutions, but that wasn't really the source of the problem. There's a lot of things that are being done, a lot of things being proposed, but I think one should look at the fundamental cause of the crisis. If one's really looking for a solution, the ring fencing, certain types of activities, I don't think is going to solve any particular problems. And certainly it's not going to solve the problem that caused the financial crisis.
But I would say, I mean, the one, I think, and I'm not again taking a position per se, but if you follow what the logic is, if you think there's riskier activities, and you come back to where I talk about winding down an institution, if you want to protect the bank, if you have the broker-dealer, which is again funded more in wholesale markets, if there is a problem, you can wind that down without necessarily, having the FDIC, for example, go in and rescue the bank, as you have that level of capital that you could, in a sense, fold up to recapitalize the institution. So, like I said, I think by separating some of the activities that you may deem to be riskier, you can kind of separate, again, the bank from, the broker-dealer and some of the markets activities you may not deem to be appropriate in the bank if you have just one entity. So,
Kevin, how does that work in Canada?
Well, we moved to universal banks before the United States in the early 90s, and it's worked quite well for us. The one thing you want to make sure is that you adjust your regulation for a universal bank. So in other words, you have to have common regulation. The regulator has to understand and work simultaneously on all parts of the activities of the bank, and you have to set the leverage and the other things for that. So, but I don't think, again, it's inherently the fact that you have a universal bank with all the activities. You have to make sure the bank manages for it, and you have to make sure that you coordinate the regulation and the regulatory rules consistent with it. It's when you don't move one with the other that I think you can get
And Kevin, how do you do that?
Well, in Canada, we have a single federal regulator for kind of the banking kind of operations, and we set a single overall consolidated all assets, all geographies leverage rule for the banks. And that plus mandating risk management in kind of the board committees, and in fact put onus on everybody to make sure that they understood what the balance sheet was like.
Sorry, Senator Corker, I think I interrupted you.
Yeah, I think all of these discussions over the last year, and we've written numbers of letters to regulators about all of these things, but I think whether it's the Bear model or the Honig model or the Vickers model, I think all of these are good to discuss and to try to look at what is the best way to have our financial system as a whole, not just the large banks, but as a whole, to work properly. So I'm glad that each of these models have come out, and I think each of them give us an opportunity to poke and probe. I just hope that all in Congress are poking and probing and not just reacting with emotion to the problem, okay? But I think they all play a good role, and I don't think we have quite finished the evolution as to how we're going to end up dealing with our larger institutions and the system as a whole. I will say one thing. I'm up here with Citi, and I know that everybody thinks that J.P. Morgan and Wells and Alt Citi and Bank of America kind of calls Congress to do certain things. The overwhelming sentiment in Congress, I can assure you, is not with the large institutions. Mm-hmm. It's with the community banks across our country. And that's where the political clout is. I'm thankful, though, that up until this point, I didn't think Dodd-Frank was a good solution, but up until this point, as we look at the evolution as to how to deal with these large institutions, we're still doing some poking and probing, and I think over time, we may well get it right. But there's no question that within Congress, and I think within our country, there still is a concern about large institutions failing and how we deal with those, and I know at some point during this hour, we're going to talk a little bit about that.
Yeah, well, I kind of wanted to transition from here into capital and then into resolution regimes, because if somebody could put up slide, I think it's now 15. And if you look at slide 15, this is a simplified version of the new capital rules. That was supposed to elicit a little bit of laughter in the background. So that's the simple version of it. Basel III, some argue, is extraordinarily complicated. It moves us to higher capital levels. It creates a new Tier 1 common ratio. It eliminates the use of certain types of capital instruments. It tries to do some sort of global leverage ratio and the like. I guess really to the panel as a whole, can everyone weigh in a little bit? Will these rules work, and is this part of the solution to ending too big to fail?
I mean, I'll approach it at least from a couple of different angles. I know we talk a lot about being focused about what happened in the last financial crisis, and there's been a lot of discussion about resolution authority, and I applaud all of the regulators all across the world who've been working on this. But I'm most concerned, and maybe this is the consumer in me coming out, is I'd rather find a way to prick the bubble and slowly bring it under control than wait till the end and try and find some way to resolve a massive financial institution. I look at the capital requirements, I look at accounting requirements, and those to me still don't answer a question that I know every regulator struggles with, which is you can have that chart and you can make it 10 times more complex, but what is the Tier 2 capital you actually hold in an environment where there are people you can count on one hand in each of the major financial institutions who actually understand what's on that balance sheet, where the trades are being executed and knowledge of those trades dispersed throughout. It is incredibly difficult to think about how you would actually exercise resolution authority. And I know there are lots of people, the FDIC spent a lot of quality time on this. But it's hard to think that's going to go swimmingly given that I think the unknowns and the opacity sort of swamp what is known.
Well, James, maybe to quickly digress from capital, and we'll circle back to it in 1 second, but is he right? I mean, are institutions, is it possible to resolve these large institutions?
I can't resist saying something about capital.
Please.
Could. I think a leverage requirement is appropriate. I don't think anybody paid any attention when trying to determine the solvency of a big bank by looking at the risk-based capital measures. I think the risk-based capital measures provided next to no information whatsoever. So I think it's a good idea to have a leverage ratio, whether it should be 3% or 5%. Is a different sort of issue. I think when you look at this table, everything's too complicated, and I do think one has to be wary of believing that simply raising capital requirements is a good thing. I think we can raise capital requirements too much, and that could lead to higher loan rates. It could lead to less availability of credit. So I think there's a downside to raising capital requirements too high, and I think in some cases that's indeed the case here. We may be raising capital requirements too high. With respect to the Dodd-Frank Act, Orderly Liquidation Authority, Orderly Liquidation Fund, I think we don't know yet whether indeed it's going to work. I think there's perhaps a political element that's been injected because ultimately...
Wait, politics? No, that's not
the Secretary of Treasury, in consultation with the President, has to determine whether or not indeed a bank, say a big bank, is indeed subject to being put into receivership by the FDIC and dealt with by the FDIC. And perhaps the Senator would like to say a bit more about it.
Yeah, I mean, do you think it can work?
First of all, on Basel III, I mean, the fact that OECD sovereign debt has 0 risk rating is a joke. I mean, that is unbelievable. And so there's no doubt that changes need to occur in Basel III, and certainly there's no reason for a community bank or even a regional bank to be subject to Basel III standards. That just makes no sense. I can see it for the large, more complex institutions that obviously go across various countries. On Title II, I mean, the big issue right now is the FDIC has decided on a single point of entry. In other words, it's not really orderly liquidation. They're coming in at the holding company level. They've realized that these banks are so intertwined, they really, and not stovepiped, that there's really no way to liquidate these entities. That's what they've figured out. So the question is, will you force the holding company to have enough debt, enough long-term debt, so that creditors know they're going to be hurt? And how do you deal with the subs? I mean, at the end of the day, the way it now is set up, if you're a lender, you wouldn't loan to the holding company because you know what the FDIC is going to do. You'd loan to the sub and you'd be held harmless at the end of the day. So I think that has got to be fixed. Now, you were talking about the Treasury Secretary, you were. At the end of the day, he's making a decision as to whether it's going to go through bankruptcy or whether it's going to go through Title II. I actually think Title II can work. Again, we've got to figure out a way to make sure that at the holding company there's enough long-term debt being held there and that all the equity is going to be wiped out. And I think if we can do that, it could well work. But at the end of the day, let's think about it. What happened in 2008 was a systemic crisis. So will Title II work in a one-off situation? I think absolutely, if we make the corrections that need to be made to it. I'd rather see a bankruptcy process, a Title 14 in bankruptcy. I'd rather see that occur than Title II. I think that's much more judicious. But at the end of the day, usually these things happen when there's a systemic crisis. And so if you can imagine going in and doing Title II at every large institution, trying to put in place a new board and a new CEO, that's going to be problematic. And so I get back to what my friend from Canada has just said. We need to make sure we're doing everything we can to make sure that banks are actually operating in a good capacity. We have a mechanism now that will allow us to resolve them, but again, typically that occurs when a systemic crisis has happened. And what we need to do is do as much as we can to allow entrepreneurialism and risk to take place, appropriate risk, not dumb them down too much, but certainly be a whole lot better in looking at how these institutions do have capital and how they're regulated.
I mean, I do think that capital and orderly liquidation authority or resolution are very linked, and maybe we can keep our conversation going, sort of linking the two. And to shift over to Carrie, what would happen to Citigroup if some of these proposals that talk about a 15% equity to asset ratio were actually to be put into effect? Some have equated that to around a 25 to 30% Tier 1 common requirement, and I apologize for the lingo, but it's just two different ways to measure capital. Right now, the requirement is 7%, and you could conceivably be going to 25 to 30% under some of these ideas, a quadrupling of capital. What would that do to the bank? Either of you? Either of my bankers?
I guess one of the questions you have is, where do you get that capital? Like, who's going to inject that into the system? And I think, simply put, is, the cost and availability of credit is going to change dramatically. Again, it's very simple. If you're investing in a bank and you want to earn some return, you may say, okay, now it's a much lower risk entity, but you're still going to earn some type of return. So what's going to happen is the availability of credit will go down and the cost of it will go up dramatically. And if the system decides that it wants banks to underwrite to a zero loss threshold, we can force that on the industry, but there will be a cost to society. Like I said, will be much lower cost of availability of credit, a much higher cost. And if you plot, economic growth against credit growth, you'll see a line that goes like that. When you have very tight credit conditions, you tend to have very low credit growth. And not that, again, very loose credit is a good thing, but higher and more available credit tends to be good for economic growth. So I think you have to decide is how do you calibrate that? If you make it too onerous, there'll never be another failure, there'll never be another problem, but there may not be much credit available, and that's going to be a challenge for growth.
Kevin, would you want to operate in the United States at that kind of system?
Well, I think everybody should kind of think about it. I mean, again, everybody agrees that we should have more capital, so that's not the issue. The debate is how much, how complex are the calculations, what's the phase in, and are there level playing fields, right? So the devil is in the details. The more you ramp up the amount of capital, as Carrie said, it's going to increase the cost of lending, and it's going to decrease the amount of lending. And we have an economic challenge as well. So we've got to find the right balance between providing a bigger buffer but also making sure we have a financial system that can lend to small and medium-sized enterprises and other things. And so I don't think it's an issue of either or. It's an issue of finding that right balance. I think the capital buffers are important, but fundamentally, we want the banks to kind of run well. That's our first line of defense against either individual bank failure or systemic problems in the future. And I think the buffers are a second line of defense.
James, one of the issues that we often hear is that if capital requirements do get too high, banks may actually be forced to take excessive risk in order to try to make a return. Does that make sense to you? Is that a risk here?
Yes, I think indeed it is a risk if capital requirements are raised too high, as just pointed out. It turns out there's another risk. Banks will securitize more loans, take them off the balance sheet. The securitization market will grow. That may create problems. And the other thing, there may be an incentive to basically shift a lot of the credit to the shadow banking sector. The shadow banking sector may grow, and the shadow banking sector, we know, is less heavily regulated than the banking sector. So do you want to shift a lot of activity from the banks that are heavily regulated and have all that activity show up in the shadow banking sector that's, again, less heavily regulated? So I don't think simply raising capital requirements to 15% or 20% is going to solve all of our problems. Then I think we're going to have to look at the shadow banking sector and make some decisions about, are we now going to impose capital requirements on that sector? Are we going to now more heavily regulate that sector? So I don't think simply focusing on banks and imposing all sorts of additional requirements on banks is going to solve our problems. Funds can shift to other parts of the financial system.
Senator, do you think Congress is going to act in this space? I mean, we hear so much on capital coming out of Capitol Hill, but is this a real risk?
I've read some of your publications where you calculate it's a 30% risk. I think that's probably about where it is. I think there is you have the Brown-Vitter bill that just has come out that does many of the things that were just, and there's, it's how does Congress decide? One of the things it's pretty stunning when you've been in business all your life and you show up in the Senate and you realize that everything we do is just totally arbitrary. We just kind of make it up. And this bill, seriously, I mean, how do you decide these things?
You just disillusioned
You just kind of
an
make it
entire
up.
room
So
of people.
I don't think there's a lot of momentum around the bill that's been put forth. I do think a good first step, as I mentioned, would be, hey, let's analyze whether Citigroup is getting some kind of subsidy that because of the size that they have. And if they are, let's eliminate that, okay? But I don't think, and I think the ratios, Basel III may work well with some tweaks, like I just mentioned, regarding sovereign debt and other issues. But I think there should be some minimum ratios that are easy to calculate also for the complex institutions. For the rest of the system, I think, again, simplicity is much better. But I don't think Congress is going to do something arbitrary right now. Think about it. We haven't even begun to deal with Fannie and Freddie. We actually kind of own those, and that's $5 trillion. And you'd think that would be the first order of business as we move along, and hopefully we'll get this right. I do think there will be more machinations, but I don't think the machinations will include an arbitrary size limit that takes place in Congress.
I wanted to wrap up this issue of capital and too big to fail before we move on to some of the other regulatory issues with this issue of global rules. I mean, Basel III was negotiated on a global basis. There are certainly compromises in there. There's provisions which may not make sense in the United States, other provisions that the U.S. insisted on for Europe. If the U.S. goes its own, I mean, how much do we have to worry about sort of a race to the bottom once this crisis, is a little bit further in the rearview mirror? And, do we need a global agreement? Is there a benefit? How do you prevent cheating? I kind of throw it open to the panel if anyone wants to interject.
Well, I was saying to folks earlier, 2 weeks ago I was on a panel which was all about how we needed to take bank regulatory authority away from the federal government and push it down to the states. So the exact opposite of this. And I do think that when you're talking about large capital flows and that there is a real role for harmony, but that's different from having one set of global rules, and that's different from having sort of one set of global regulators. For Main Street, there's a lot of virtue to actually having the person down the street being your regulator or your enforcer. And to go back to Senator Corker's point, when you talk about community banks and an enormous amount of banking in this country, it's hard to see why a global financial regulator is actually going to make those institutions function better.
Let me, I mean, again, this is probably kind of being Canadian and kind of looking at a big global financial system, and we always worry about kind of the rules of the game and the level playing field. And if you start kind of from the, I guess, the first meeting of the G20 in Washington at the height of the crisis, I mean, broadly agreed on principles for kind of the system. What you're seeing, I think, increasingly is people are actually holding to the principles, but the actual regulations are fragmenting. And if we want, and we live in a global financial system, kind of where corporations operate across the globe, fundamentally that can't be good. And just to give you some examples, I mean, the banking structure. Vickers is bringing in a different banking structure than the Volcker rule, which is different than the Likkonen rule. So you're starting to get three key regulatory kind of systems in the world have got three different views about banking structure. That's actually going to make it more complex, not less, and then complexity is the challenge for kind of error. So I worry kind of if we live and operate and we think it's important in a global market, how do we have both national sovereignty and effective coordination of kind of rules for global trade?
I think that might be a good way to transition or segue into something that Senator Corker mentioned earlier, which is the idea that there's a zero risk weight on sovereign debt for many European countries. We've certainly seen in the headlines that troubles in Europe can result in troubles in the United States. What happens to sovereign countries is certainly impactful across the board. But what do you do with sovereign debt? I mean, how do you, if you have a group of countries, how do you actually control that if you're a U.S. regulator? I'm not sure there's an easy solution here. Kind of an open question is, how big of a threat is this? James.
Well, we have moved in Dodd-Frank Act to no longer require that bank regulatory authorities rely on the credit rating agencies for basically trying to determine the financial condition of banks. We now have the OECD with country ratings, basically. They go from 0 to 7. And the risk weighting goes from 0 to 150% with respect to sovereign debt. So is that going to solve the problem is an issue. And we know, as the Senator pointed out, that in many cases what the banks were able to do is put sovereign debt on their balance sheets and basically treat it as zero risk rating. Obviously, sovereign debt, much of it is should not be treated as with a zero risk weighting. It turns out, look at Argentina, which has defaulted on sovereign debt more than any other country in the history of the world. It turns out one of the contentious issues today seems to be whether or not subsidiaries of foreign banks should be basically require that the foreign banks be capitalized to the same extent as domestic banks. That's an issue now. And it has to do with whether or not, say, a foreign bank operating in the United States, if it gets into trouble, can the U.S. regulatory authorities hold the parent company or deem it to be a source of strength, basically? How do we be sure that we can protect, basically, depositors here in the United States, basically, if a subsidiary bank gets into trouble? That's leading to what people are calling balkanization of regulatory authorities, is that different regulatory authorities are going to treat perhaps foreign banks somewhat differently than they used to treat them. China does indeed require that foreign banks, the branches now have to be separately capitalized. That's to be sure, basically, that there's more protection for domestic depositors and creditors in banks operating in China. So that's an issue that has recently been discussed.
But isn't a sovereign crisis always going to lead to a banking crisis? I mean, aren't the two almost, basically joined at the hip? Kevin?
I don't think necessarily. I think what the danger, and you see it, I mean, Cyprus was a great example, right? You had a banking system that was having large inflows from various areas, and they needed assets to put on the balance sheet, and they thought Greek debt was a really good asset to put on the banking sheet because, as the senator said, it was zero risk rated. So, strangely enough, had a sovereign debt. But we have to remember is that there is a dangerous mutuality of interest between governments that have way too much debt and profligate fiscal positions and banking systems that would like some highly rated debt. And you see that in a number, frankly, of Eurozone countries right now. And so I think the problem is, if you have stable fiscal positions, you're usually not going to get a banking system into a sovereign debt issue. But if you don't have a stable fiscal position, then you risk having a mutuality between the two systems. And I think that can lead to problems.
All right, so I want to switch gears here, and we're going to run through some of these other issues a little more quickly. But one of my favorite issues right now is clearly the financial transaction tax. Europe is enamored with it, or at least some European countries are. Others are starting to question it. There's legislation in the U.S. that would impose a 50 basis point tax on stock sales, 10 basis points on bonds, and 0.5 basis points on derivatives. France has already imposed a transaction tax. There's worry that the online sales tax legislation that the Senate had been considering could lead to state-level transaction taxes in the United States. Where are we headed on transaction taxes, and do they make sense? And as we're starting on Capitol Hill, I guess we are forced to put Senator Corker in the spotlight here. What do you think?
There's no discussion of it. During the crisis, it's been looked at as a pay-for some fiscal issues that we have, but I don't see it having any legs. I'm a strong supporter of the Marketplace Fairness Act, where states have the ability to collect sales tax that are already imposed on citizens, but that are not being collected. And I know that some of the financial groups were concerned that that might lead to a state financial transactions tax. I just see no evidence of that. I think everybody, again, should always watch Congress closely. But I don't see any uptake right now for a transactions tax, and certainly I would not support that.
Kerry, what would it do your business if we had a transaction tax?
I think it would severely impact market liquidity. And again, you come back to, what are we trying to accomplish? Is this really a revenue tool, or is it more populism? And if you start thinking of, whether it's Basel, liquidity requirements, regulatory requirements, austerity, you're just squeezing that growth balloon, and you add the financial transaction tax, we're not going to cut our way to prosperity, and, again, more so in Europe. But at some point, you have to, I think, step back and what are you trying to solve for?
All right, where's my stage manager? What do we do with that?
I think I said something I should have said, maybe. But
That was
That's
incendiary.
the city police are coming down on you?
but so again, I think.
May I have your attention, please? Our hotel response team is investigating an alarm that is sounding. Please remain calm. We will notify you with further instructions. Thank you.
It's a very common.
Why do I feel like this is out of Airplane where,
We'll notify you with all further instructions. Thank you.
okay, with that lovely backdrop, let's
So
go to.
if I can just finish that
please.
thought. So really, who gets hurt there? And you think about job growth, when market liquidity gets impacted. On one side, Basel III essentially for the banks is they want us to lend to like IBM and GE and let the small companies who generate all the job growth, let them go to the bond market. Now you go the other way and say, okay, we're going to really restrict liquidity. And if you restrict liquidity and you're a money manager, you may say, you know what, I can buy a 7 or 10-year bond on IBM or GE because I feel pretty good they'll be there at maturity, or if I really don't have to sell it. But that small company that's in the Midwest somewhere, you may not want to, and you probably can't make that bet. It isn't like, you know what, if I add a couple 100 basis points, that transaction makes sense. It becomes binary. And ironically, you come back to the source of job growth and economic growth are the people who get squeezed out of the banking system and out of the bond markets. And that's what worries me a bit as you continue to impose, these, I'd say, somewhat uncoordinated policies. When we all try to, where does growth come from? Some of these are counter growth and not necessarily solving the problems of the crisis or preventing the next crisis.
Yeah.
Well, that's actually a great transition into slide 14. If we can get slide 14 up for a second. Maybe. Okay, well, while that may or may not Actually, I'm sorry. Our slide numbers are a little different here. Slide 13 in the new deck. Okay, so when we're talking about the shadow banking system and banks, you know, I mean, one of the things that we hear a lot about is, you know, before the crisis, we had huge non-banks, Goldman Sachs, Morgan Stanley, Bear Stearns, Lehman, AIG, Merrill Lynch, New Century on the mortgage side. You know, today it seems to be the banks, but we have a lot of concern that the non-banks or the shadow banks are going to come back and are going to be big on a global basis. You know, can someone on the panel talk a little bit about, you know, what are the shadow banks? You know, who are these players out there, and what should we do about them?
I think this
You
is,
want- Tom, you wanna take
well, you know, and
first
there
shot?
obviously there are different definitions of this, but whether it's, you know, hedge funds and private equity, but a host of other entities that are trading derivatives or creating securities. I do think that this goes back, Carrie mentioned the idea of a financial transaction tax and populism. I do think that I see no populism supporting such a thing in the United States, but I do think there is a lot of populism that gets to this concern that there's something happening, maybe not at the big banks, maybe at the big banks, something happening on Wall Street that has been unfair to retail investors. The idea that there's someone else lurking in the background who either knows more information, gets to trade in a different place or in a different way, and somehow has an advantage. And I think with the growth of shadow banking and you know, was it 10% of pension funds are now in hedge funds, at least numbers recently suggested, there's going to be more and more interest in transparency there, and I would say sort of good old-fashioned regulation on things like insider trading, you know, the situation, the high-frequency traders and concerns about them if they're making deals with themselves to change market prices, and then obviously off-exchange trading, where there's been a lot of debate recently from the exchanges about what's happening behind the scenes, if that really is 40% of the market. That sort of suite of issues, because I think there is a real concern among consumers that something is happening that they aren't getting the benefit of, I think is going to start rising to the top.
Senator Corker, and then James, we'll jump to you. But, you know, Senator Corker, Dodd-Frank created the Financial Stability Oversight Council. They have this authority to deem institutions as non-bank SIFIs or systemically significant non-bank financial firms. We haven't seen this used yet. Is this a way to tackle that problem? Can it work?
Well, I think they're going to name some institutions just because they have to have some scalps. You know, they have to say that they actually did that. But I don't think that necessarily does anything. I mean, the fact is, if you look at the way we regulate our system, we heavily regulate banks. What we should migrate to is a situation where we're actually regulating activities. And that way you get away from some of it being regulated and some of it being in the shadow banking system. But there's no doubt, look, if you're a really, really bright prop trader, or you've been doing, you're not going to be in you can't be in an institution anymore. These people, I mean, smart, entrepreneurial, talented people are going to be leaving our banking institutions over time and going into the shadow system because it's just much easier to operate. And so we need to migrate again away from this huge focus on the institutions and move to a system that really regulates the activities, and we have not figured that out yet.
James?
Well, following up on what the senator just said, if we were to ask people what is the difference between a banking product, a securities product, and an insurance product, most people cannot answer that question. And indeed, under the law, if it turns out the banking regulatory authorities, the insurance regulatory authorities, securities regulatory don't agree, it's a U.S. federal district judge that determines whether or not a product is one of those, falls into one of those three categories, which tells us something about the nature of the financial system today. The shadow banking system does include the finance companies, mutual funds, money market funds, the private equity funds, the hedge funds, and it also includes some financial instruments such as the repos and commercial paper. And we had some problems in those areas. So I think if we squeeze banking too much, all we're going to do is force a lot of those activities into the shadow banking sector. if it consists of the recent estimate about $23 trillion, it's already bigger in size than the regulated banking sector. So I think one does have to worry about the shadow banking sector. But again, it does provide some benefits. A lot of it's due to an increase in demand for financial services, basically, more liquidity that's provided by that sector. But one doesn't want to make the mistake of over-regulating banks and ignoring what's happened in the shadow banking sector. Worldwide, I think the estimate is just under $70 trillion.
I think at this point, we will open the floor to questions. There is a microphone in the center of the aisle, and if you could come up to the microphone and please identify yourself, and feel free to direct any questions to particular panelists. I was going to say, while we're waiting for somebody to come to the mic, I was going to ask a question, but I can already see we have somebody at the mic. So, sir, take it away.
Hi, I'm Bruce Brown from Cal Poly Pomona. I just have a really quick one. On the slide 13, I believe it was, you put up, it showed the commercial banking sector growing and shadow banking shrinking in 2008. And I'm wondering how much that might be due to the reclassification of former investment banks as commercial banks. I think some of what were investment banks, and I guess considered part of the shadow banking sector, then were reclassified as commercial banks.
Carrie, you want to tackle that, or you want? I mean, I think if you look at that chart, I mean, I think that it certainly does reflect part of Goldman and Morgan Stanley and American Express and others coming over to the banking system. It also stops in 2011. So, you know, I think if we had some more recent data, you would actually see that shadow banking line start to tip up. I don't know, James, you have anything you want to add?
Yeah, it's what one actually includes in this the slide that was put up. I think shadow banking is much larger now than that slide would have indicated. I don't think it probably includes perhaps maybe the commercial paper market, repo market, and some of the other institutions that we're now identifying as part of the shadow banking system. It's all depends on what one includes or doesn't include. But I think the banks, obviously some of the Goldman Sachs and Morgan Stanley, we know, converted to bank financial service holding companies, so now included in the banking sector.
You know, Carrie, do you see these? Are you competing against the hedge funds and the shadow banks in your business?
In some businesses we are. In others, you're seeing a migration of activities away from the banking sector. And, you know, I think if things continue to play out, you know, in a sense, you know, some of our, you know, best clients today, you know, we're going to partner with them. And in a sense, you know, some have used the term like we're in the moving business, they're in the storage business. And I suspect you'll see less risk kind of housed in the banking system, rightfully or wrongfully, and more moving onto the balance sheets of many of our clients, and they're setting up middle market lending operations. You hear a lot of that in both the U.S. and in Europe, because in a sense, we may all agree the right level for a loan, let's say, is 6%, and you have to hold a certain amount of capital against it. Well, because of Basel III, we may have to now hold the equivalent of 8%, where that loan would make sense. So what our clients are doing is going to their clients and saying, you know what, the right risk or the right level on that 6, the banks have become cost traders, they're at 8, let's lend at 7, and we created an attractive risk-adjusted asset for, you know, for our investors. And so you are seeing that activity. It's not, again, it's gradual, you know, but you're definitely seeing that. And like I said, I use middle market lending as just one example. Where that's happening, like I said, both here and in Europe, for example.
Yeah.
I mean, just you know, to follow up on the same point. I mean, one of the challenges is often that there's a danger in regulating what's easiest to regulate, and since we have regulatory systems set up for banks, it's easier, you know, to keep doing that. The challenge is, the center said, to the extent it's the functions that worry you, if the regulatory and the changes, you know, are broadly appropriate that we're imposing on banks, why wouldn't we impose them on other key financial kind of intermediaries? Because if it's actually important to change behavior along the lines of those changed regulations, presumably we want that to impact the entire financial system. So I think the issue of making sure it's a level playing field goes back to making sure that we have a robust financial system.
But doesn't that come back to access to the discount window, FDIC deposit insurance, which is why, you know, U.S. banks have one system and perhaps shadow banks have a different? I don't know, James?
Well, one thing I would like to say before we close is I think we've overlooked one important cause of the financial crisis, and that's the regulatory authorities. I think they did an absolutely miserable job in enforcing the existing powers that they possessed, and I'd like to make that clear. That's my view. It may not be shared by the other panelists, but I'd be willing to talk about it. So I think basically we have to hold the regulatory authorities more accountable than we have in the past because of the poor performance. I do think that that's something that is frequently overlooked when we talk about big banks being perhaps bad banks. We don't talk about the regulatory authorities having an absolutely miserable job in fulfilling the responsibility that they had to the American taxpayer.
And I think
Yeah,
access-
a lot,
Oh, go
a
ahead.
lot of people don't, this is brief, a lot of people don't realize the Fed was the systemic regulator. I mean, that was clearly under their mandate. So you talk about a total whiff during the financial crisis. I mean, it was the Federal Reserve that had those responsibilities, and it's interesting, when we went through the regulatory process, you know, the Fed was being kicked around, and, you know, as it turned out, the Fed, again, came out the winner throughout the regulatory process. I couldn't agree more that we have focused way too much on banks. We need to focus on activities, and we're creating risk in the system right now as people move away from these institutions that are regulated. We need to get ahead of that curve and come up with a much better regulatory regime than we now have.
All right, so we got 2 people in line. We got 4 minutes and 10 seconds, and we have somebody who has a hook who's going to pull us off as soon as that light turns red. So whoever's at the mic, go ahead, and we'll get through these 2 questions.
Sure. This is Chris Cole from Artemis Capital Management. I'm particularly interested in just open panel discussion about some of the new regulations coming online this summer that will require certain institutional investors to post collateral on OTC derivatives transactions. The concept being that this might require an additional depending on who you're talking to, $2 to $10 trillion of collateral postings. Whether this will lead to a shortage of high quality collateral, and maybe if there might be unintended consequences of that type of regulation, and just to see your views on that.
Go ahead.
Somebody want to
Mike.
tackle derivatives? Go ahead, Kevin.
I mean, there are lots of proposals again for kind of more collateral, so the devil's in the amounts. But I guess the other issue I'd raise on the
Well, I mean, this is a requirement, though.
Yeah.
It's not a proposal.
No, I
This is-
understand.
Yeah.
But I guess the other thing I'd raise on in the OTCs, you know, we've had a commitment that we'd have clearing, but you're now getting quite different regulatory interpretations between the EU and the United States. So we could end up with 2 parallel clearing systems, an EU one and a US one. Strikes me that's not in kind of anybody's best interest as well. So again, it's interesting where you can get fragmentation that often with the best intention will end up with very bad unintended consequences.
Senator?
You know, we have this debate not just with the institutional investors, but the end users. And I have to tell you, during the crisis, I thought that, you know, the end user exemption probably made a lot of sense. Because I see that we're not regulating activities, we're regulating institutions, I'm becoming slightly more ambivalent about it. And we are paying a lot of attention looking at this kicking in a little bit later on, and candidly need to do some more work on it. But because I know that the system has the flaws in it that we have, I'm a little bit more ambivalent to pull people out from posting collateral. So you won't like that answer.
I think we have one more question.
Thank you, Michael D. Really 2 questions. I like the idea about regulating activity, but I would draw the dividing line between where's the taxpayer on the hook and where is the taxpayer not on the hook. Banking in its core function is a utility, like turning on a light switch and getting the water. I actually think we've gone from 20,000 banks down to 7,000 banks. 450 banks failed during the crisis, 800 are on the watch list. I actually think we need more new kinds of banks, and Dodd-Frank is stopping those new kind of banks. Why can't we have a Google bank, an Amazon bank, a Walmart bank, a Starbucks bank, and try new banking models to get credit to SMEs from institutions that are in those areas as a distribution channel. So on the one hand, I actually would like to see more new kinds of banks under a highly regulated umbrella where the taxpayer's on the hook. Where the taxpayer is not on the hook, that's where the risk in the system should be located. The hedge fund part of this falls under the Pension Benefit Guaranty Corporation, and the government is on the hook for that. So when hedge funds are taking pension money that's guaranteed by the government, that should be much more highly regulated. So I see this dividing line between the two, and I'll just leave it there. Thank you.
Okay, we got 30 seconds, so James, fire
Well,
away.
Let me jump in, because Milken Institute has done a report on what are called industrial loan corporations.
ILC.
We all know the problem. There are about 9, I think, federally insured depository institutions in the United States that are owned by non-financial firms. Toyota, BMW, Flying J, if you know Flying J, Harley Davidson, motorcycle company, owns a bank too, an FDIC insured bank. It turns out the Congress decided to put a moratorium. FDIC did. They wanted basically the Congress to decide what to do about the ILCs. Most of them are located in 2 states, Utah and Nevada. And it turns out not a single commercial, non-financial, commercially owned FDIC-insured bank has ever failed in the history of these countries. Corporations are sitting on $1.7 trillion or so in cash. Just think if they had used that to help recapitalize the banking system by putting it in to these types of institutions that needed more capital. We currently have a moratorium that's still in place, so Walmart, other firms, Starbucks cannot buy an FDIC-insured commercial bank. It turns out that I think we're out of step with just about every other country around the world. I think there are a few countries, offshore places, in which perhaps they prohibit the commercial ownership, non-financial commercial ownership of banks. So that is a possible way to go forward. We'd be in step with China and many other countries.
All right, I know my job is to give the senator the very last word.
No.
So Senator,
I
what do you
think one of the fair hits on Dodd-Frank and other matters we've taken up, like the ILCs, that we have stifled innovation in this country. So the last speaker, I would support us having the ability to, we have such advantages technologically in this country that I do think we have stifled innovation. I'd like to see things opened up as you have suggested. I don't know every detail, but I agree with the comments that are made. The ILC issue was one of huge political debate, and I think we've made some mistakes in Congress, a few.
all right, thank you to the audience for not panicking when the lights went out. Thank you to the panel. Enjoy the conference, everyone.